On June 14th, two-year U.S. Treasury yields printed a high of 3.43%, which was the highest level in over 14 years. Now, since that time, it's cratered over 50 basis points down to a current level near 2.82%. The narrative surrounding Fed policy is changing rapidly as well. Although the futures markets remain convinced that aggressive rate hikes are coming in the near term, the belief has changed as to when the Fed will conclude its tightening and if the terminal rate will be between 3% and 3.25% by July of 2023. In addition, the economic outlook has changed as well. The Atlanta Fed GDP model is now predicting negative 2.1% GDP growth, and the Bloomberg economic model suggests 38% chance of a coming recession. Although inflation remains stubbornly high, there are some signs that the economic slowdown could ease some of that pressure. Specifically, the 5-year break-even rate has fallen from 3.7% in April to a current level of 2.6%, and copper is down nearly 30% in the same time frame. If a trader believes that the Fed will soon signal a more cautious approach and that two-year U.S. Treasury yields could head lower from here, they could express that by selling the July micro two-year Treasury yield futures contract at 2.87 and target the May lows of 2.40. A stop for this trade could be placed above at 3.10. This trade could make $470 if your target is reached and risks $230 if you're stopped out of your level. Now, if a trader believes that rates will resume higher, perhaps on a resurgence of inflation, they could express that by buying the July micro two-year Treasury yield futures contract at 2.87 and target a move to the June 14th high of 3.43. A stop could be placed below at 2.65. This trade could make $560 if your target is reached and risks $220 if you're stopped out of your level.